Diversification in the stock market? How? Why? And when? My head hurts. Hi guys, it's your favourite YouTuber again, Diversifying, and you're watching Diversifying. Whoa, 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 whoa. Now I bet those are the questions that you guys are asking yourself. And without fault, most people that invest don't actually realise how big, how important diversifying yourself is. And the reason why a lot of people don't understand it is because they don't know how it relates to the stock market or just to investing in general. So there are a lot of people that invest in the stock market that don't actually know what diversifying means. Like, I always knew what diversifying is. It's not like I recently found this out. You know what I mean? Like, huh? You said something? I think my mum's calling me. I'm just gonna go see my mum. Mum, you said something. Sorry, yeah. But yeah, why? Well, why do you need to diversify? Think about it. If you had one stock, well, not one stock, all of your stocks in one market, that means that you're tied down to that one market. Yes, the market might be booming right now, but that market might take a turn, which means your whole portfolio will go down because it's dependent on that one market. So if you had stock in the food industry, for example, and then say you bought stocks in McDonald's, you might not want to, well, you definitely won't want to invest in stocks in, I don't know, KFC, for example. You definitely don't want to do that, because if the food market is doing badly, then both of your stocks are gonna do badly because they're correlating, they're relating to each other. You haven't diversified as much as you should have. Whereas if you invested, okay, cool, in McDonald's, and then you want to invest, say, in a tech company, so say like Apple, for example, then guess what? If that food industry is doing badly, Apple's got no relationship with McDonald's from what we know. You do know that, okay, cool, Apple can still be prosperous because it's not related at all. That's why you need to diversify. And you can see how that manages your risk. The way you can do that, determine which companies are correlating, which companies are uncorrelated, is by actually looking at their market. If you have a company that is in the food industry, then you may not want to invest in other companies that are in the food industry. Not the way to go. You might want to invest in a different market. And it's not just with markets, it could be countries as well. So maybe I want to buy a stock in UK, I'm based in UK right now, I want to buy a stock here. Maybe the market, well, definitely the market's going to be completely different all the way in China, for example, or the USA or Australia. There's different sorts of groups of markets in which you can diversify. So don't just limit yourself to just the industry. It could be countries, it could be types of products, it could be electronics, it could be food, it could be agriculture, it can be, there's different combinations. So you basically want to spread your stocks across as much as possible and diversify in that way. The good thing about diversifying is that you can start anytime. Anytime you're thinking of investing, that's when you can start diversifying yourself. So you want to understand the market that your stock that you already own is within, and you want to make sure that the next stock that you're going to buy does not have a relationship with that. A good way to actually tell that stocks are different, they're not really correlated, is by looking at the share price. So as the share price goes from time to time, from years to years, has there been a general trend with both two or more stocks? So if you know that, okay, cool, in 2018 they both 2018 what's wrong with me 2017, that they both went up and down at the same point, at the same time, then you know, okay, it's likely these stocks are definitely correlated, these stocks are pretty similar. Whereas if, I don't know, in 2010 that stock was really booming all the way to 2015, for example, and then that was your tech stock, and then maybe your stock in the oil and gas industry has been steadily moving between 2010 to 2015, then you know that, okay, cool, it's highly likely that those stocks are quite diverse because they're not following the same trend with the share price. There's actual formulas available online, so if you guys look and find books, there are books that can actually allow you to determine whether two or more stocks are tightly correlated, and upon which you shouldn't invest because you're not diversifying. It's important that you guys know that it just doesn't stop there. It's not just with, okay, the food industry or the tech industry or the housing industry or the oil and gas industry. It's not just there, and it's not just with the countries. It could be different types of investments. Maybe you want to invest in the stock market, but think broader, open your horizon. Think about investing maybe in a property, but also investing in a mutual fund, but also investing in bonds. So that's another way to sort of diversify yourself. I just want you guys to sort of see where I'm going with this. Diversifying yourself is a really good thing. With that said, do not diversify yourself too much, okay? I bet your mum told you too much of anything in life is not good for you, okay? Unless it's some DS Learning Finance videos, yeah? But that's another matter. Anyway, yeah, too much of anything is not good for you. So if you have too many stocks to deal with, then that's gonna overcomplicate your life. Because you gotta think about it, if you have 20 different stocks that are all diversified, you just simply go mental. Like, I personally struggle even multitasking 3 things at once. So if imagine multitasking like 20 different diverse stocks at once. Yeah, you're not going to be able to give each stock that individual sort of attention to research and analyze it as time goes by. You're not going to be able to, which means you will lose money. So with that said, you don't want to diversify too much. You want to have 4 to 6 different things, different stocks going on, and learn from there and make sure that they're all diversified with each other. And don't forget that diversifying only minimizes your risk. It does not completely get rid of it, okay? You're still gonna have a risk by investing in a company. What really makes you make money is by doing your research and learning about that company, really learning. And that's the end of my video, guys. Did you like it? You don't have to say a word. I know you did. I can feel it. I can see it. But yeah, don't forget to like, subscribe and share. LSS, DS Learning Finance. Whoa, 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 whoa. Bye guys.